Hello, everyone, and thank you very much. I would like to extend a warm welcome for you, and thank you very much for attending this session. My name is Mahmoud Al-Kudsi. I'm a Chief Market Analyst in Capex.com. Very good company, a startup company, and it's been a pleasure for me to join it. And right now, we're going to talk about reversal patterns in technical analysis. But before we get started, we would love to read together the risk disclaimer, which is this is not an advice, this is not a trading advice. However, all content in this session is for educational purposes only. So before we get started, we would like to talk about Capex.com. Capex.com is a regulated company from ADGM. We work under the ADGM rules, and also we've got to mention that the client's money is being saved in a different account number from the account from the bank account of the company, as a very good segregation step for the clients. Again, our trading condition second to none, competitive spread, execution, and price transparency. Also, our clients have the privilege to trade over 2,000 markets like Facebook, Google, etc. And also, we've got on our platform integrated tools beginning to gather to gather the knowledge and skill the market expertise. Talking about our platforms, we've got the MetaTrader 5 and the Capex.com Advanced Trader. MetaTrader 5 is the successor of the well-known MT4 platform. Everybody knows about it. And the Capex Advanced Trader, very highly competitive platform, advanced charts, customizable layout. So the user of this platform has the possibility that he can customize the platform according to his needs. Also, Trading Central, third-party company that could provide a trading signal according to their point of view, if the market is going to go up, is going to go down. Also, we have to take into consideration that it provides also the pivot levels, support, resistance that could be working as entry point, as an exit point. Also, negative balance protection, self-explanatory, risk management tools, stop loss, take profit, very easy to use, and sophisticated analysis tools, so you can have a very good experience in terms of drawing on the chart and applying multiple, over nearly 100 oscillators on this as a package, which is great, very powerful tool, and key statistics about the market, whether the market was bullish, was bearish, the opening price, the close price, very highly important details that any client or any trader has to know about the market he trades. But wait, there is more. With Capex.com platform, we've got insider hot stocks, i.e. the owners of the stocks as directors of companies, if they sell their prices, how the market reacts to this sell. You can find out about it through the platform, and it also could be a signal, trading signal, whether or not was the market bearish or bullish. So you can take advantage of this. Also, daily analysis rating. You've got a list. With this list, you can find out about the top analysts in the market, and they follow specific market, specific stock market, and their advice, whether or not if it was sell or buy, and also the targets that you could follow when you place the trade. Bloggers' opinion. The most famous bloggers in the internet, you've got a list of them, and also you can find out about the market trend, whether or not it was bearish or bullish according to their point of view. Hedge fund activities. biggest speculators in the market, hedge funds. Everybody knows about hedge funds, I think. And they have to maintain their clients happy as they charge hefty fees. So also, you're going to have on the platform a list of hedge funds companies, and you can find out what are the moves that they've done on their trade. Did they increase their trade? Did they reduce their trades? So that could be also a very good piece of knowledge and a signal, trading signal you can find out about in order just to make your trading decision. And finally, news sentiment discover what's being relevant in the media for 7 days. So whether or not the market was bullish or was bearish, and also you can have the piece of news, or let's say the articles being written in the media worldwide about a specific market. So yeah, that's it pretty much, and we can get started with our subject today, which is fundamental versus technical. Could be a small or tiny overview. So everyone knows when he trades the market that we've got two schools. We've got the fundamental school and we've got the technical school. So the fundamental school, it focuses on the supply and demand, and technicals focus on the price action. And if we are trading the market according to the fundamental rules, let's just say the Forex market, we need to pay attention to too many details like the GDP, inflation, unemployment, etc. On the other hand, the technical school is quite different. The technical school pays attention to the support, resistance, trend, and momentum, etc. So they are completely different school. And I was always being asked the same question every time: which one is better? And I wouldn't say there's one better or one worse. I would say like they are complete each other. So if I want to trade the market, I need to take into consideration the fundamentals of the market and the technical analysis of it. Okay, in the technical analysis, we've got patterns, we've got the continuation patterns, and we've got the reversal patterns. So the continuation patterns are the patterns that they show in the middle of a trend. So we need to have a trend before, and then we need to have a kind of a shape. This shape, after this shape, we can say the most probable the market is going to continue trading in a specific direction. And we've got the reversal patterns. When we see this shape, we're going to say that the most probable that the market is going to reverse its direction. So if we've got a bullish momentum, and we see this shape after, so the most probable the market is going to reverse and is going to go to the downside. And if we've got a downside trend, and we've seen these shapes that we're going to talk about them today, so that means that the market is going to reverse, or the most probable that the market is going to reverse and is going to trade in an upside world. Okay, by the end of this session, we will find out how many patterns there are. We're going to find out how do I spot these patterns on the chart, and simply, how do I trade them? Okay, the most non-reversal patterns. We've got the head and shoulders, inverted and normal, double top, double bottom, triple top, and triple bottom. And I guess that too many people here in this court, they've heard about it, or they maybe traded these patterns. So let's get started with the head and shoulders pattern, and it is a bearish pattern. How did I know that is a bearish pattern? We agreed before that these patterns are reversals. So I need to have before that the price is going up in an upward move, and then after I spot on the chart the left shoulder, the head, and the right shoulder, I already have the pattern. However, the most important detail in this pattern is what we call the neckline. Why? Because it's going to help me, how can I trade this pattern? So if I spot this pattern, if I spot the head and shoulders, and then I see that the price broke below the neckline, so that means that I've got a potential entry point. And as we see here, that this pattern, sometimes the price or the trend breaks below the neckline, and could or not, it's not necessarily, but it's usual that the price breaks below the neckline and goes up up again to test it. So if the price tested the neckline and then continued trading in a downside move, so that means that the pattern has been even more validated, and it gives me a better signal. So I can get into the market on the break of the neckline first time, or the market could give me the second chance to use this pattern when it rebounds back from the neckline. An example on the Aussie Kiwi, as we see here, that the price has been trading in an uptrend. So this is point number one. I have a specific clear trend upward, and then I have the shape. I could recognize it, the shoulder, the head, and the next shoulder, and then the most important, the break below the neckline. As we see here, that the price broke below the neckline and then bounced back, went up, tested the neckline, couldn't break above the neckline, and then kept going down. So this is a traditional head and shoulders example. Okay, the next pattern with us, we've got a bullish pattern, which is the inverted head and shoulders. The same exact concept, but we've got it on the reverse, which means that before we had an upward trend, and here we have a downward trend. After that, everything is copy and paste, the same. We have a left shoulder, we have the head, and we have the right shoulder. So when the price breaks below the neckline, what I have to do is, or when it breaks above the neckline, what I have to do is to measure the distance from the head toward the neckline and then apply the same distance to the upside. So that could be my potential target. And then, as I said before, it's not necessarily that the market could provide me with a second chance, but if the market breaks below the neckline and keeps going up, so that's fine because it's going toward my target. But if it goes down and if it breaks below the neckline here in this example, so that means that I have a negated or invalidated pattern. So I need to be very careful with the neckline because it's one of the most important details in these patterns. Example on the dollar yen, as we see here, we had a downward trend. We have lows with lower lows, and then, as we see here, we've got the head, and we've got two shoulders, and then the price broke above the neckline and kept trading above. So the price reversed its downtrend to an uptrend move. Next pattern, the double top pattern. It's a bearish pattern. As we see here, we've got an uptrend, and then we spot on the chart the first top and the second top, and then we have to spot the neckline. The neckline, as I said, I keep insisting, and excuse my repetition, but the neckline is one of the most important details in these patterns. So how can I trade this pattern? Very easy. As long as I have an uptrend move and I spot two tops, and if the price breaks below the neckline, so I've got a trade opportunity. I've got a trade opportunity, and I can trade on the break on the neckline. People, they put their entry point on the neckline. This is wrong. I need to wait until the neckline being broken, and then I can place my entry point. So some people ask me how many pips I have to wait. I would leave it to your discretion, but I have. And I have to insist, I have to wait until the break line to got broken so I can use this pattern as an entry point. Example, we've got dollar Swiss franc. As we see here, we've got an uptrend. We've got the first top, the second top. The price broke below the neckline and then traded below. And as we see here, broke and then rallied to test the neckline. It failed, and then it kept trading to the downside. So this is one of the traditional things that these patterns can do. However, we can't guarantee that this pattern or the price would do the exact same thing every day. Okay, the next one, double bottom pattern. It's bullish, the same exact thing. We've got a downside trend, and then we've got double bottom, and we spot where is the neckline. So how can I trade it? Very easy. First, I checked. I have a downtrend or a bearish trend, and then I've checked that I've got two bottom, I drew the neckline, and then trading it's by measuring the distance from the first bottom toward the neckline, and then I apply the same distance to the upside, so I've got my potential target. And as I said, I need to wait for the neckline to be broken so I can get my entry point. Example, we've got pound Kiwi, as we see here. We've got a downtrend, lows with lower lows, and then double bottom, and the price broke below the neckline. However, as we see, broke above the neckline. However, as we see, the price broke and continued. So as we said before, sometimes the price tests the neckline again, and sometimes it doesn't. Okay, the final two examples, or the final two patterns with us today, are the triple tops and the triple bottoms. And I think like the concept was clear for you guys. We have to have a trend, we have to have a specific shape, and we have to have a break below or above the neckline all times so we can trade these patterns. So as we see here in the double bottom, I have a downtrend, 1, 2, 3, I drew the neckline, then the price broke above it, and on the other side, uptrend, triple top, and then the neckline, and then the price traded below it. How can I trade them? Very easy, the same exact method. I measure a distance from the first or the second top toward the neckline, and I apply it in the upside when I have a triple bottom, and then I have on the other side an uptrend and triple tops, and then what I have to do, measure a distance from the top to the neckline and apply the same distance. And then, as we know, we can place our entry points on the break above or below the neckline, depending on the case. The example here we have is the Kiwi dollar. As we see, an uptrend, triple top, 1, 2, 3, neckline, we drew the neckline, and then after the break, below the neckline, we measure the distance and we applied the same distance from the head to the neckline, applying it to the downside, and we've got already our potential target. So that's it for today. I wish that I have helped and I added something to your extensive knowledge. And if you've got any questions, please let me know.